Thank you, John, for having me, and Ana Maria for a very interesting paper. I found this paper interesting, thought-provoking, maybe a little unsettling, some troubling facts. And so most of my comments are really about questions that I think this research raises that we might want to address. Just by means of summary, we find pretty stark evidence that from both the HRS and the National Financial Capability Survey that debt is rising for workers that are nearing retirement. We see a big effect of housing debt, but that's not the whole story. Other forms of debt are also increasing, and so we think near retirees are more financially fragile and holding more debt. I think that the focus on near retirees is particularly interesting when we think about debt because younger workers having access to debt is probably a good thing, at least some kinds of debt. We want them to be smoothing consumption over the lifetime. Mortgages and student loan debt could be good things. There's always types of debt that are clearly bad. When we think about near retirees, it's a little less clear why debt would be good for them. There's certainly some reasons, but there are also questions about how bad this could really be. The first question I think that comes to mind is whether or not this is the accumulation of many years of overspending, in which case the policy intervention would be potentially complicated as workers are at the end of their career and holding on this large debt. Or is it the case that older individuals are taking advantage of the easy availability of credit, they're taking on new debt at older ages, which of course raises the question of why lenders are willing to offer this debt to people who are towards the end of their careers, and whether or not this is indicative of some predatory lending practices or some sort of market failure where government intervention might be needed. This raises a question for me about whether some of our social safety net and public insurance programs are disincentivizing asset accumulation and maybe encouraging people to take on more risk in more recent cohorts. And so this is just some initial evidence of a potential looming crisis coming where people aren't accumulating as many resources as they near retirement. And then finally, and I'll sort of end with this question of whether instead of all of these kind of doomsday scenarios, maybe what this is actually early evidence of a big change in just the course of the life cycle. So 57 to 61-year-olds are no longer near retirees, but maybe they're just kind of earlier in their whole cycle of earning. And so I'll talk a little bit more about that at the end. I want to focus first on mortgage debt because I think a large part of the story that Ana has put together has to do with housing wealth. And we see some very troubling statistics from the National Financial Capability Survey that a lot of people are underwater in their homes. I think that's always bad and very troubling. But having a high ratio of mortgage to home value could be bad, but it's not necessarily bad. So this, I think, leads to some questions about what people are going to do with their housing wealth as they enter into retirement. Are they bringing mortgage payments into retirement, which could be very expensive and harm their ability to consume in retirement? Or is it the case that people are just holding equity in their home that they plan to access as they transition into retirement? And owning an expensive home, I think, is not necessarily bad at all. So the data that Anna showed shows that in the HRS, the median value of the primary residence rose quite a bit between the earliest cohort and the most recent cohort in the HRS. But the ratio of the primary residence to total assets did not rise by very much. And so this led me to question what the patterns of non-housing wealth holdings are across the three cohorts. And maybe this is actually evidence of a good thing that people are getting richer, and so they're buying more expensive homes. And maybe that's not necessarily bad. And also interested to understand whether or not some of this housing mortgage results is due to the housing bubble in 2004 when it was really expanding. And so I wonder in the HRS, at least, if we could consider some regional variation in the intensity of the housing bubble to try and unpack how worried we should really be about these very high mortgages that people are holding as they're nearing retirement. When we think about other debt, it's a little bit easier, I guess, to see that this is worse for older workers. If this is mostly credit card debt, that's non-collateralized. It typically has high interest rates. Student loan debt may be less important. And there's this puzzle that emerges in the HRS about people who are holding positive assets and yet have other debt. And this statistic that I found quite striking, that in the earliest cohorts, only about 6% ratio of other debt to liquid assets, but by the more recent cohort, it's up to 55%, so a really big jump. And so I was interested in, I'm not sure that you can do this in the HRS, actually, or the National Financial Capabilities Survey, but even just to think about more broadly, are there cases where holding liquid assets and debt makes sense, and cases where it's clearly bad? So it's clearly bad to be saving when you're holding high-interest credit card debt. It may be bad if you're saving while holding low-interest debt, but it's probably okay if what we're doing is seeing people just change their asset portfolios altogether. And as people are nearing eligibility ages to withdraw retirement savings, it may be very sensible not to be having your money in a savings account, but instead to be utilizing tax-preferred savings vehicles. And I think, in particular, I have a question here about how we're really accounting for retirement savings for these workers who maybe should be holding very small savings accounts because the retirement savings are more liquid. They're more accessible for them. And so, as I was reading through the paper, I was really concerned, thinking about whether or not there is this crisis looming. And so I just wanted to say a few words about period versus cohort effects. I think one of the things that we can clearly see is the Great Recession had a big shock to household wealth, and we're seeing some of the ramifications of that. As Anna mentioned, it could be easy access to credit has led to a debt holding problem for more recent cohorts. There could be social insurance programs, or maybe near retirement is a changing target. And so I wonder if you could use the National Financial Capability Study to try and disentangle some of the cohort and period effects. So here's my very rough attempt to do that. Using this very troubling chart that Anna just showed, that shows very high levels of financial fragility across the entire life cycle. But what we can look at here also is perhaps some within cohort improvements over time. So if we take the very earliest HRS cohort, they're older in the financial capability study, and the light blue bars are when they're surveyed in 2012, and the dark blue is when they're surveyed in 2015. And we actually see that their financial fragility is going down over time, so they're kind of doing better as they get older. And the war babies are doing worse than the HRS baseline, but they're also improving over time, as are the early baby boomers. And so I think this is at least suggestive that there could be some life course change that's happening where people are just more financially fragile, ages 57 to 61, but they're going to be financially stable by the time they stop working. And so this could just be early evidence of people who are planning to work for longer. And maybe there's some slight optimistic results that, at least within cohorts, there seems to be some recovery that's happening between 2012 and 2015. So the Great Recession caused a shock. Maybe there's some recovery. Near retirement could be a changing target. I'll just end with 4, I think, questions for public policy that this paper raises in my mind. And the first is whether or not what we're observing is near retirees building up a lot of equity in their home, and are they going to attempt to access that in retirement? And if that's true, are the elderly overexposed to the housing market, and are current tax rules and financial products incentivizing people to act in a way that's sensible and going to lead to retirement security? Secondly, are current regulations regarding lending protecting near retirees? Older workers may be entering into cognitive decline. They may have less experience with credit. Is this new credit that's being offered to them indicative of some failure in the market? Are current social insurance programs incentivizing excessive risk-taking? And is that bad? And then finally, if individuals are systematically undersaving and or overconsuming, are we going to see a rise in really bad outcomes for the elderly as these more recent cohorts age? And I think it would be very interesting to look, and I think it's been long enough now that we would start to see the cusp of rises in bankruptcies and dependency on public programs and dependency on family members, which would give us some sense of whether or not there really is a crisis coming, or is this just the start of people working longer.